Hey everyone, happy Friday. Today on the Final Bar, we will wrap the week. We'll focus on how the markets have evolved from last Friday to this Friday. A lot of movement this week, an acceleration to the downside on Thursday, end of the first quarter, beginning of the second quarter today. Nice little rally going into the close, but the S&P back below 4,600. A lot of defense at the top of the list with real estate and utilities 1 and 2. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on this market environment. Pay attention to the signals the markets provide back to us in the form of price action, price, breadth, and sentiment, helping us better understand the behavior of individual investors and how that combines all those buy and sell decisions combine into indicators about price and investor behavior. This week has been a fascinating week. I'm thinking of some of the conversations I had with guys like Mark Newton and others, trying to make sense of things, trying to take a longer term perspective, given a lot of short term movement, a lot of short term uncertainty. And I think that's the best thing you can do in this sort of environment. Jesse Livermore is famously quoted as saying, "There's a time to go long, a time to go short, and time to go fishing." Arguably, this might be one of those third times when it's better to go fishing and wait for all these things to play out, particularly as we go through, options expiration last week. We've got quarter end this week, plenty of moving parts. However, we can still draw some information back from the market with the defensive feel to April 1st here. We have great guests on the show. I had a couple really good conversations this week. Next week, some more good guests for you on Tuesday the 5th. We have author and educator Kathy Donnelly joining us back on the show. On Wednesday the 6th, Mike Zaccardi, who's one of our columnists for the Top Advisors Corner on StockCharts.com. On Thursday, the 7th, Bob Lang from Explosive Options joining us on the show. Once again, all of our previous interviews, by the way, at StockChartsTV.com. Let's continue on today's show and focus on wrapping the week. We have a couple pieces to this wrap the week segment. We're actually going to start with a poll. We asked you recently on our social media accounts, also on our live stream page, which of the Americans performs best over the next 3 months? American Airlines, American Express, American International Group or AIG, or American Eagle Outfitters. Now, this is a play on a chart that was in the Fidelity chart room decades ago called the Generals, following General Electric, General Motors, General Mills, all these big general names, big industrial companies with the word general in their names. So we play on that and look at Americans. The number one recipient today was AIG with about 37% of the vote. I can't say I disagree with you. I was actually talking with Grace and Rose earlier today. We were chatting about a number of things, and we often get on a call together to talk about stock charts related things, but we immediately go to the markets and start looking at charts and comparing notes on things. And we're just looking at the strength in insurance names. The financial sector has certainly been struggling, but a lot of insurance stocks have actually been fairly constructive, right? There's a property casualty ETF we were looking at together, but AIG is a good example of that sort of renewed strength. In the last couple of weeks, you've seen AIG, I think, transition from an uptrend and a basing pattern to actually breaking above resistance. On the chart of AIG, for example, I think staying above the 62, 63 level is pretty meaningful. That's a resistance that you saw at the end of last year, beginning of this year. Holding above that would be pretty constructive. But this is a nice long-term chart with consistent relative performance. American Express was the second most common answer here with about 32% of the vote. Not a bad chart, right? And again, compared to other charts that I've seen, it's not horrible. The problem I have with American Express is it's now putting in a pretty clear, I think, lower high, right? So an uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower highs and lower lows. So charts like this, establishing a bit of a lower high is a bit of a problem. So this remaining below 195, I would argue, is sort of different. So AIG, you have it breaking above resistance. American Express, you actually have it failing to get above a previous resistance level. You also have the $200 level, which is often a key one. Airlines, I have not made probably too much of a secret of how much I don't really enjoy the airline stocks over the last 6 to 8 months probably. I think making the new high in mid 2021, if not March of 2021. From there, I think they've been in a pretty clear downtrend, and they've had these really seductive rallies where they've whipped to the upside and made up a lot of gains very very quickly. But the reality is they've not really eclipsed the previous highs until American Airlines gets above the February high, until it gets back above the 200-day moving average. It's a little bit above where we're at right now, around $19 a share. I think this chart is still going lower. And again, not a judgment call, just based on the definition of the trend. Lower highs consistently is a chart in a downtrend. It can get above 19, it can get back above the 200-day. Then I will start talking about why AAL and other airlines might be an interesting play here. Let's continue on our wrap the week segment. Second chart we're going to look at is looking at these five major asset classes. We're just looking at the last 5 trading days. So we're starting the clock end of day last Friday, taking us to where we're at today. And just to walk through, if you follow my mouse, I'll explain to you what each of these color coded lines represents. In black, right at the zero line, the S&P 500. So all the movement, all the volatility we had this week on the S&P, it was an unchanged week. It was unch from last Friday, right? Zero, basically 0.1% if you round up to the nearest 0.1%. But that's not it's not much of a week. Stocks essentially went nowhere using the S&P 500. What underperformed the S&P this week? In green, we have the dollar ETF, the UUP, which is down 0.3%. The gold ETF, the GLD, was down 1.6%. The worst performer was crude oil, down 8.1%. Now, of course, this is crude oil giving back 8% after being up many percents year to date. So fair to have a bit of a down week and give back some of those previous gains, but certainly the weakest of the major asset classes we're following here. Everything else actually outperformed the S&P this week. In purple, we have the small cap ETF, the Russell 2000, right around 0.7%. The Nasdaq 100 was right about at the same level using the Qs. In orange, we have emerging markets. This is the EEM ETF, which is up 1.9%. Next up in red, we have bond prices using the TLT up 3.1%. The best performer this week, Bitcoin, actually up 4.5%. It's been interesting to watch that rotation on cryptocurrencies. And I've been interviewed a lot. I feel like every 2 to 3 weeks, I get an interview request for either Bitcoin or Ethereum or some mix of the two. And in the last, previous discussions, we've talked about this structural downtrend, but recently, particularly this week, you're seeing a nice rotation the last couple of weeks from charts that were in a consolidation phase to breaking higher, and Bitcoin really breaking above resistance. Looking at the 200-day moving average, Ether as well, and a lot of the major coins are having nice rotations back to the upside, which is interesting because I think a lot of times they can be thought of as a proxy for speculation. So these are charts that are in a strong position in terms of speculation or speculative pressure coming back into the market. To finish off our wrap in the week segment, let's look at the Mindful Investor live chart list. This is a list of charts that I keep updated on StockCharts.com. If you've not seen our Friday show before, you can access this chart list at any point by going to the articles tab at the top of our webpage. Go to my page, which is called the Mindful Investor. You'll see a button at the top to access this list of charts that I keep updated from my login. We start with the market trend model. It's actually an interesting moment. I haven't updated the text yet, but as of the close today, we are just barely registering a bullish signal from my medium-term trend model. Medium-term trend model for me turned negative second week of the year. So in early January, it had been positive for most of 2020, almost all of 2021, turned negative 2 weeks into the year and has remained bearish. So what's happened in the last couple of weeks, it's been long-term bullish, short-term bullish, and medium-term bearish. Given the strength that we saw in the last couple of weeks, really, and really just maintaining those gains with an unchanged week from last Friday, that's enough to push my medium-term trend model back to bullish. So for me, that medium-term trend model is the main risk-on or risk-off measure. That tells me, in general, to be thinking about adding risk or taking risk out of a portfolio, if you think of it sort of strategically. So that turning back positive tells me to think more risk-on, to be looking for opportunistic plays and to put cash to work with risk assets. It is so tough, and there's a reason why I don't manage money or do anything automated based on this model. Because of course, I get in an argument with the model. I literally argue with the chart at times. This is one of those times. It does not feel medium term bullish to me right now. This is probably why it's a good thing to have a model that takes that guesswork out of it. The daily chart of the S&P is really a fascinating one, and I think there are a lot of different things we could potentially look at. I added the 100-day moving average, and I won't keep it on here, but I just want to add it today. I was looking at Andrew Thrasher shared a note from earlier today talking about the 100-day moving average. He's highlighted that before, and others that I follow and converse with regularly are big fans of the 100-day moving average. I've never really been big on it, but I thought there was some value in what they're saying, which is let's reflect on what moving averages have tracked the price movements pretty well. And if you look at the 100-day moving average, this is where we bounced off of in September, October of last year. Also in December of last year, we broke down through there in January and actually came right back up to the 100-day in mid-February, now rotating lower. So this week, getting back above the 100-day, which is pretty meaningful until today, right? Until the last couple of days. Yesterday, we closed back below it. Today, you literally are right at that level. So I think instead of finishing this week in a position of strength, while we've regained the 100-day, this is now a bullish phase. I think it's still a question mark, right? When we went from breaking above 4,600, finally closing above 4,600 for the first time since January, to having absolutely no follow through. You have a bearish Harami pattern. And if you've ever wondered why you would follow candle patterns, it's for things like this. They just work really well sometimes. And you scratch your head and wonder why you don't pay attention to them all the times. It's where you have a big up day followed by a down day. Day two's range is embedded in the first day's range. It's a short-term reversal signal. And so yesterday and today make a lot of sense if you think about it. Basically indicated a strong influx on Tuesday's session, no follow through on Wednesday, and actually some short-term weakness, which told you short-term weak going through the remainder of the week. So at this point, we are right at the 100-day moving average. We are above both the 200 and the 50-day in the market. I would argue is really more choppy, neutral than anything. Let us continue on. And I'm actually, as I review this, just to highlight one of the really cool new features. We have a lot of new features that were released on StockCharts this week. Grayson Rose on his show this week, just he recorded earlier today, called StockCharts in Focus. He featured on one of those, or he focused on one of those new features that we released. Over the next 5 to 6 weeks, we'll be incorporating one of those new features every Wednesday on the show and sharing it with you. But I just want to highlight we have a new view called Scroll View. So if you have a big list of charts, this will just keep, it's a perpetual list that'll keep updating as you scroll down. It's a really nice new feature that our development team made happen this week. Second chart, or the next chart to look at in our Mindful Investor Live chart list, is the breadth by cap tiers. You will notice if you follow this show regularly, color coding has changed a bit. As of this Friday, I'm changing all of these from bearish red to neutral amber orange color. And the reason why I've done it is this: all four of these, if you look at these blue horizontal lines, all four of these advanced decline lines have now broken above their February highs. They're all above their 50-day moving average. So by my reading, this is back to a neutral color. I wouldn't call these bullish yet, because I think you need to get back to new highs for the year to really confirm a bullish influx of positive breadth, positive follow through on a lot of individual names. But at this point, I can't continue color coding them red. I did that when we made new swing lows in early March. I've now turned it back to neutral now that we've broken to a new swing high. That's encouraging. What's not encouraging is a lot of stocks are struggling to break above resistance. You have the NASDAQ going right up to resistance and falling. That's around 14,500, if I remember right, not having the chart in front of me. Apple failing to get above its previous highs, right, sort of stalling out at resistance. So that's kind of the feel that I have going into the weekend. But the breadth is turning back neutral. I would say by that measure. Here we're looking at the percent of stocks above their 50-day moving average and the percent of stocks above their 200-day. We'll spend just a moment here because I think this could be an interesting chart. This top panel here, which is showing you the percent of stocks above their 200-day moving average, this is only using the 500 members of the S&P. It's currently just about 50%, around 54% as of Thursday's close. That remains above 50%. This remains in a bullish configuration. If it gets back below 50%, that's bearish. The fact that it dipped below there in January was, one of many negative signs telling you there was some broad deterioration in the equity markets. It getting back above 50% is certainly a check in the plus column. Here's a really interesting look, though. If you look at this bottom series, just look at the last 8 or 9 months or so, right? Since the third quarter of 2021, every time that this percent of stocks above their 50-day, when it's gotten up to about 70%, that's been a top. That happened here in late August, early September. happened here in November of last year, happened here in January of this year, and we're right back there as of Wednesday's close. You have the run up to make a new swing high, and we have over 70% of the S&P above their 50-day, and that has been what the last three, fairly significant tops, or at least cyclical tops in the S&P have all had that similar look. On the downside, when this indicator has gotten below 30%, that's the low from September of last year. That's the low from December of last year. That's the low from January. And that's the low from late February, early March. So it's actually been a range bound indicator, and 30 and 70%. It's almost like looking at an RSI as an oscillator. It served as a pretty good oscillator, tracking this real consolidation phase that we've seen in the S&P over the last 8 or 9 months. I think that's actually more of a negative signal. It tells you we've had a run up. And I remember talking with Mark Chaikin when stocks were selling off, and we saw how low this indicator got. His comment was, "This is as low as this indicator tends to get. It's probably a buyable bounce." He was right. This tells me that we're maybe in the opposite, where we've had a run higher and now potentially at a short-term exhaustion signal. Final thing I want to tell you is just the bullish percent index. We'll have to leave it here talking about market breadth back above 70% as we review the charts at the end of this week. That's encouraging. That remaining above 70% tells you we're in a bull confirmed pattern. That means 7 out of 10 S&P names are in a bullish point and figure chart. That is a bullish sign for the S&P 500 as a whole. We need to take a quick commercial break. We will be back with the final bar mailbag here in just a moment.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show. A couple quick comments before we get to the Final Bar mailbag. First off, all the questions in the mailbag have come from viewers like you in the last day or two. Keep your questions coming. We're here to answer your questions on market history, on technical indicators, on particular charts, ETFs that you're struggling with. Let us help you point you in the right direction. Our email is the Final Bar at StockCharts.com. We're on Twitter at Final Bar SCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air in our next mailbag segment, Tuesday of next week. Also, go to StockChartsTV.com. That is our on-demand platform. So much great content for free. We had some fantastic documentary-style content on Women's History Month in the month of March. We did a special on chart madness with the bracketology stock picking exercise, a lot of market outlook specials, and fantastic guest interviews, all for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Let us continue on today's show with the Final Bar mailbag. Keep your questions coming to the Final Bar at StockCharts.com. Here's question number 1. Dave, I would appreciate your observation on Tesla. What are the odds it will get back to the former high of 1240? Thanks. And why I love your question, I don't usually like to take questions that are asking for an opinion on a particular chart. And I'll qualify by saying this is not a recommendation. As usual, all our disclaimers make it clear this is for educational purposes only. But what I loved about the way you asked that question, what are the odds it will get back to the former high? And there's a lot of market wisdom embedded in the way you ask it. Too many times we ask, will it get to this thing? And it's yes or no. Will the S&P close 10% higher? Yes, thumbs up or thumbs down, because we love to simplify and tie ourselves into binary outcomes. Are you bullish or bearish? Is it going up or down? In reality, investing is not like that. It's all about probabilities. I can tell you what I think the most likely scenario is, and I will tell you a couple other scenarios that I've already tried to think through, because investing is all about being prepared for what might come next. And this is why I think pilots could make really good investors, and many of them do. And guys like Greg Morris and Tom McClellan and others who have had great careers in the financial industry were pilots, military pilots, both of them, before they got into technical analysis. And there's a discipline to their thinking that I think is very, very clear. So thumbs up on the way you asked that question. What are the odds? What are the odds that it gets back to the former high? I would say fairly good. And I will tell you why I think that's the case. getting above 1,000 is a key level for Tesla. This is a big round number. When anything like Tesla hits a big round number, I remember when Apple hits 1,000, Alphabet, Oracle. I remember all these charts as they hit 1,000. It's a thing because adding another digit is just like something going from above $5 or when it goes above $10 or 100. It's a way for a lot of people to mentally revisit: is this chart really deserving to go further? I like the strength in the chart. I like the fact that we've made a higher low and now made a higher swing high. I think the potential of it going back to 1250 is pretty good, and I think going higher than that is a real possibility as well. The challenge for Tesla, as with many sort of emerging growth stories, and I think there could be much more emerging growth on something like Tesla, is the fact that the environment's not necessarily going to be great for that sort of story if and when interest rates continue to move higher. But from a purely technical perspective, I think that's great. And if you want more of the bull Tesla case, tune into Tom Bowley's show because he will happily give you that anytime, I'm sure. Next question: Bullish Percent Index $ BPNDX of the Qs reached 109.7% today. And I'm sorry, I'm laughing at all the acronyms we managed to pack into a sentence there. Is it due for a pullback? Other indicators such as RSI are not indicating such. And thanks for sending the permalink. By the way, if you're asking a question about a particular chart, below the chart and in ACP as well, there's a way you can send a link. If you include that in your email, it's really helpful for me to look at exactly what you were looking at and hopefully address your question. You're talking about this series at the top. You're looking at the Qs and you have $BPNDX, and you're saying it got above. So I know what happened here. So what happened? What's actually happening? And you want to change this for the person that sent this in. At the bottom, you are actually using what's called price performance. So it's actually doing a percent change in the bullish percent from the left side of the chart, which is not a great way to look at bullish percents. It's already defined in percent terms. So you want to change that to price. If we do that, it's going to make a little more sense. There we go. So now that should range from 0 to 100. So it peaked out about 87% or so, which makes a lot more sense. So you're looking at the bullish percent within the components that make up the NASDAQ 100 ETF essentially now. So is it due for a pullback? Absolutely. I think the fact that so many of these names were in a buy signal can be a bit of a concern. There are ways when you're using the bullish percent indexes to look at extreme readings. Here's the thing though. So for a leading indicator, yes, it getting that high above 85% is concerning. That's when you start looking for signs of a reversal. Getting below 70% is usually the sign that things are going to get worse. So if you look at when it was above 70% and rotated below, here is November of last year. Here we saw it again in February of this year. That's what I'd be looking for, which would be a real sign that there's a downside follow through. At this point, it's pulling back, which is reasonable after such a run higher. What concerns me more about the Nasdaq is less the breadth here, but it's more just the chart, the fact that we stalled out at the February highs and have not been able to get above that or the 200-day moving average. Great chart, by the way, though. Next question. $NYTOT, does it include the unchanged issues? I'm a 21-year member and I can see your offices from my house in Redmond. Good to see you, fellow Pacific Northwesterner, and I'm glad you're nearby our office. At some point, it'd be awesome to be able to open up our office for more really cool stuff. But we are continuing to try to be safe as possible with our office space. You're asking about $NYTOT, and this chart isn't going to look super pretty, so sorry for that. But this is actually looking at the total listings in the New York Stock Exchange. So and the reason why I think you're asking that is because one of the breadth indicators that I show, I'm not going to be able to find it super quickly. I look at the percent of advancers versus total. Actually, I do think I know where it is. It's right in here. If I look at my breadth list and I say percent advanced decliners, yeah, here I'm doing New York advancers as a percentage of the total number. So that includes everything, which does include unchanged. So what some people do, like Walter Deemer, I've argued with him about this kind of thing as well. What some people do is advancers over advancers plus decliners, and you ignore the unchanged values. To be honest with you, I don't treat this as a tried and true like I'm super focused on a particular level. I use it more for a read on the movements and how they change over time. So I don't mind necessarily that denominator is not ideal. I'm looking at how much are up versus how much are down, and looking at the difference more than anything. But yes, to answer your question, it does include all issues, including unchanged. Next question. You mentioned how a weaker dollar, stronger euro could be a headwind for gold prices. Would you mind expanding on that briefly? Would more money shift to euro instead of gold? Yeah, really good question. And sorry, I'm a lot of times I'm sort of stuck with the fact that with the limited time we have on the final bar, I don't have a lot of time to dig into deep philosophical issues or structural issues about the market. I try to cover them as much as I can, and then point you to places that you can get more color on it. But yeah, so here's the thing: when you're looking at the dollar index, right, the dollar sign USD on our platform, you got to remember this is the dollar weighted against other currencies. So the dollar on its own doesn't have any particular value. It's not like it's denominated in gold anymore, right? It's denominated in dollars, right? It's how many dollars do you get versus other currencies. And so the way you really quote the dollar traditionally is to look at the euro or the dollar yen or cable, which is dollar pound pound dollar, right? So British pound versus US dollar. And because currencies don't have an absolute value, it's all about what the value is relative to something else. So you actually use what's called an FX cross. EUR USD means euro to dollar. How many euros versus the dollar? And you can quote it inversely and do dollar sign USD EUR, and you get the opposite of it. Currencies are super confusing. So sorry for that. Long story short, the euro going down basically means it's weakening versus the US dollar. So this is looking at the relationship between two currencies. So if the euro is weakening, that means the dollar is strengthening. And the dollar sign USD is actually the dollar relative to a basket of other currencies. So it's relative to the euro, the yen, the British pound, the Swiss franc, and maybe the Aussie dollar. I forget what else is in that dollar index, but it's basically weighted versus those things. And it's about 50% versus the euro. So weaker euro means stronger dollar. Long story short, gold is denominated in US dollars. Now, you can look at gold in other currencies. You can divide it, look at the ratio of gold in Canadian dollars or gold in euros or something like that, and take the dollar component out of it. But gold is denominated in dollars. So if the dollar is strengthening, by definition, it's harder for gold to gain value in dollars because the dollar is becoming more powerful, right? It's a stronger. It's actually has more value relative to other currencies. That was a probably confusing, and I apologize for that, but run through the FX markets. I'll try to spend some more time on those things and clarify over time. We need to wrap today's show, though, folks. You go to the 3 and 3, three charts in 3 minutes. Let's wrap the show. First off, we were looking at the S&P 500. Brett using the AD lines in our wrap the week segment. We talked about the renewed strength in the S&P, the fact that we broke above 4,600 this week, but didn't close above there. We actually closed back below, which I think could end up being a meaningful thing. And it's not just that. If we look at some of the other, particular stocks and ETFs, they broke higher, but didn't potentially, but didn't really follow through. You saw that with Apple. You saw that with the Nasdaq 100, the Nasdaq Composite. Instead of powering through to finish this week in a position of strength, it was more of a defensive feel to Friday after weakening at the end of the day on Thursday session, the end of the first quarter. So, having said that, I'm seeing improvement in Brett. So I would say Brett is not negative anymore, but it's not bullish yet. It's neutral. That's why I'm color coding all of these orange. I think this is an important chart to watch because the bull case for stocks would have to include these Brett lines going higher. I think that's important to watch. Chart number two, we looked at the wrap the week chart, which looks at the weekly returns of some major asset classes. I just wanted to look at quarter to date and looking at year to date returns. I did a monthly chart review for my premium members at Market Misbehavior earlier today and shared some really interesting long term charts, thinking about the big picture, taking a step back from the flickering ticks of the market and looking at the big picture. This is one of the charts we looked at, or a version of that. We talked about some major asset classes year to date. It's worth noting it's basically crude oil and everything else. The USO is up 36%. Second to that is gold up 5%, the dollar up 2.8%, Bitcoin basically flat. And then you have a bunch of other things that were down. This was a tough first quarter, one of the worst first quarters we've seen in a number of years. Finally, MJ, the news today from Congress that continuing to see improved legislation on legalizing cannabis more on a federal level as opposed to state by state. MJ and other cannabis ETFs really have not followed through to the upside yet. Important charts to watch going forward. Folks, that's a wrap for this week. And thank you so much for joining us every weekday after the close for the final bar. For StockCharts.com, I'm Dave Keller. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.